The old microphone. Let me start from the beginning. Welcome, everybody, and good afternoon. It's now 1:02 p.m. Let's get this informational meeting of the Public Service Commission started. We have before us today NorthWestern Energy's Finance Department. Why don't you go ahead and introduce yourselves?
Travis Meyer. I'm the Director of Corporate Finance and Investor Relations Officer with NorthWestern.
Crystal Dell, Chief Financial Officer, and I've been with NorthWestern about 18 years.
Dan Roush, I'm the Treasurer. I've been with the company a little over 20 years.
Andy Durkin, Manager of Regulatory Affairs, been with NorthWestern for a little over 6 years.
And Jeff Berzina, the Controller at NorthWestern. I've been with the company for about 18 months now.
All right, very good. Thank you for introducing yourselves. At this point, I would just turn it over to you to start your presentation.
Well, good afternoon, everyone. Hopefully the mic's good. Sound good? Okay. Chairman Brown, Commissioners, thank you for taking the time this afternoon to have this hopefully somewhat of an informal session. I think it's been a while since we've been in front of you for these, depending upon dockets that we have in front of you. And at the moment, since we don't have those, we can have some of these discussions. I think the last time I was before you for one of these would have been several years ago. And at the time I was in the controller role that Jeff is now in, and obviously moved into the chief financial officer role here in February, I believe that was. So good to be with you this afternoon. We've also endeavored to not make this slide deck super long. I will tell you, sometimes it takes a lot more effort to be concise than to be lengthy. We were talking about the length of our decks earlier. With our investor decks, many times we do something that looks like about 20 pages up front, and then we put this divider, this is appendix, and we have about 40 slides in there that we cover when we need to, but we can't seem to let them go to have that. So we've tried to keep this, I think, high level and from a broader perspective, speak to you about what we're hearing from feedback from investors and how we think about the utility, et cetera. So hopefully this will be an informal conversation. If you have questions, please jump in as we go along. The other thing I would mention is this is not the full finance department. There's several folks that are not here today that lead significant areas of the business. One of those is our Director of Tax. Many of you have chatted with Aaron Bjorkman. And tax is super fun to speak about at the corporate level, and deferreds and plant and all of the above. Many of you have heard that from a testimony perspective, but Aaron leads that group. He's a familiar face to many of you, property taxes as well. He's not here today. Mike Neiman heads up also our internal audit and compliance functions. And whenever you get a chance to hear from him, one of the things that I think he brings is a lot of experience, and then also a wise counsel, I'll call it, and how he manages the compliance part of the business, and also how his team interacts with the rest of the business and really is seen as a resource in making sure we're thinking about best practice, both financially and operationally, and how we think about maintaining a strong control environment at the company. So Mike Neiman, I think, has been before you as well, and is not here today either. So with that, we'll pass around the slides for a few and talk about at a high level things that the initial comment I made from a commentary perspective, and probably what's fresh in my mind because I've just been on a bit of the hot seat with our investors, is from utility basis on an annual basis. For those of us who are investor owned, we have an annual financial conference where we all get together and the investors are there, representatives of those, the analysts that cover us from a stock perspective. That group all come together and they go around and meet with each of the utilities and hear from us about our financial plans, current status, all those sorts of things. So we just had that meeting the first week in November. That's every year, the first week in November. And so if you can imagine the number of, I laugh, blue suits all in one hotel, all talking about utility financials, it's pretty great. But we just at that conference delivered, as we always do, our next year's earnings guidance. So when you think about a publicly traded entity, walking your analysts and investors through what you expect to deliver in the next year from a guidance perspective and where you're going as an organization. And our message was a little bit of a tough message. We were the only utility there guiding down for 2022. So take your earnings. Investors expect continual growth. We announced that we expect to have lower earnings in 22. driven by our plans to issue equity. And so we'll talk about that at a high level and what we told investors there. But of course, that's a hard message to deliver. As Travis had eloquently said, even more important, it was good we were back in person for this one, because I think delivering hard news is always something that's better done in person. So we did that. We talked about our equity plans, but at the same time, spent a lot of time talking about our capital investment and investment in infrastructure, where we're going in Montana. And of course, all that goes right through the regulator and your relationship with you. So we're happy to be here this afternoon, and remiss to not say happy to be here in person and be able to engage in the discussion that way. So I'll give you a high level discussion of what we talked about with investors, and some of the slides will walk you through that as well. The other thing I would mention is always the slides that we share with investors are, publicly traded companies. So those are out on the SEC's website and our website as well. So you can always keep abreast largely to what we're talking about, from the broad financial community and where we're going. You've also recently heard from our Moody's credit analyst. You had a meeting with Ryan Wabrock. And so I'll get into a little bit more of some of the things you heard from him. And then Dan's going to share a bit on our credit metrics as well. So hopefully giving a bit of our perspective on what he shared with you and how the credit ratings agencies think about us and our financial strength, et cetera. And then you also heard from Chris Ellinghaus, one of the analysts that covers us, and we'll touch on a bit of how investors broadly view us, analysts think about us. You've seen the reports that cover us. They're certainly hold us to a standard and compare us to our peers as to what we deliver upon, and how they think about whether an investment in NorthWestern makes sense. And, and as we're competing for capital, how they think about what investors should be thinking about as to where that capital comes to us or to other utilities, that sort of thing. So we'll talk about that as a high level as well. So that's a bit of a roadmap. The final piece we'll talk about is just what's credit supportive to a financially healthy utility, things that you guys hear, I'm sure, consistently at your NARUC conferences and other things as regulators, but how we think about that balance between you sitting in between customers and us, and what's the right balance from an ongoing perspective of investment in the system and earned returns and those sorts of things. So we'll talk about all those things today, and I will endeavor to not talk too fast as well, as I have a tendency to do. So if there's any questions, please offer those up. Where am I pointing? There you go. That worked. Okay, so first slide, just talking about how we think about our role, and I would tell you how investors, of course, think about us and an investment in a utility versus others, right? Is we have a critical infrastructure role, and I think that's been highlighted in many regards. One, you think of what happened in the pandemic, and the criticality of certain industries, those sorts of things, and what electricity and natural gas service enables. We think about our role in that regard an awful lot. So there's different types of investors out there and different types of companies. You have companies that you think about tech stocks, all those kind of things, that their earnings and their multiples and all those things will be way up here. And then you have companies over here, which are a different type of investment approach. We're in that critical infrastructure sector, and we're in the what should be predictable, reliable, stable, expected to deliver service, have a significant amount of responsibility on that, regulated heavily, that sort of side of the spectrum. The other thing I would say about critical infrastructure is I think the Texas storm of last winter really, to me, put a fine point on what it is when infrastructure isn't working, and what the impact to the economy, the impact to daily lives, toll on property, all of the above. So I think all of us, as we sat separate from that, and even in South Dakota, we ended up rolling blackouts for a short amount of time under the SPP jurisdiction. But thinking about your utility service is not something that people think about very often. Hopefully they don't actually think about us very often, right? Their lights are just on, their gas is flowing, and they're not overly thinking about their utility. But they do start thinking about their utility. Many times it's in a critical moment. And so when we think about our responsibility to that work and what we do, when we manage the business from a financial perspective and manage the financial health of that, I think as we each come to work, and as I say to new employees, as you're thinking about the others don't think working for a utility is all that compelling, but I would tell you, when you look around the country and what happens when the lights aren't on, you should find your work really compelling, right? It's an interesting industry. It's dynamic. as you think about what makes the rest of the world go around, the world is a critical part of that. And as we think about navigating the financial health of the utility as it relates to that, we feel like that's a pretty critical.
Yes, I'll put it on this.
So with that, not sure what that is either. So you're working the Zoom link. So to give you a little bit of perspective, I always think it's helpful. Our role in Montana, and as we think about that, is quite different than how you think about us in perspective of the broader economy. So that top left chart shows our rate base as compared to MDU that you also regulate. And so relative size, CenturyLink and Energy West. So that's the top left of this page. So perspective, we look pretty big as compared to the amount of assets that MDU is managing. But then you look at broadly various publicly traded companies and their size, so bottom left, and you look at folks like Alphabet and Apple, and then NorthWestern Energy in the bottom right corner. We really, as a mid cap on the small side of around a $3 billion market cap, we are really small. And then you look at the largest of utilities, which is NextEra, and their market cap compared to ours, and we're really tiny. So interesting in thinking about investors and sometimes liquidity in our stock and whether they want to be in us and all the above, and their perspective on long-term predictability, consistency. Relatively, we're pretty small. Now we think about that in influence to the state of Montana. Our role is quite different here, right? When you think about the broad economy, we're managing over $6 billion when you think of our gross plant number of critical infrastructure in the state. So while from a electric and gas utility perspective and relative size to other utilities that investors may want to invest money in, to us, we're really small. It's certainly not lost on us the outsized influence of that critical infrastructure to the state of Montana and the communities in which we serve. So over to the right, again, just gives you a bit of perspective of the growth in size of utilities as well. And so you see the 1996 number compared to 2020 and the scale and size. One of the things that we've definitely seen from an industry trend, and you guys have sat there and watched this as well, is the number of publicly traded companies. The box to the right says in 97, there were, or in 96, there were 97 publicly traded electric utilities. And today there's only 38. And so that's where you see the size and consolidation that has been a key factor in the industry, and the number of utilities, which used to be a lot of local influence, locally owned. Consolidation has been a significant theme in the industry and a significant part of scale and sizability and all of the above. So again, when you think about us and our influence in Montana, very significant. When we think about being a mid-cap stock, we're relatively pretty small. So next page then gives you a bit of how we think about our ongoing investment in Montana. And so one of the things that we talk with investors a lot about is our capital plan, right? The only earnings we have is that return on our capital. And so they're interested in what's our capital spend and what's our investment look like and what are our plans. So we spend a lot of time speaking to them about where we're going and where we're going in the state of Montana. So what you see on the next slide is a much better representation than I could ever do of a picture of our capital spend for 22. So this gives you by bubbles and size where in 22 we will be spending dollars based off our forecast investing in infrastructure in the state of Montana. And I think it's kind of a fascinating look at how that spreads broadly across communities, but also the punchline here, and you see the large outsized bubble, which is investment at the Laurel Generating Station, which is over $520 million of planned capital for 2022 to invest in the state of Montana. That's a significant number. I think you all know that. But in comparison, if you look at the bottom right box and you think of where we have been, so 2019, $254 million spent in the state of Montana, 2020, $305 million, and then our 2021 forecast is roughly $370 million. And so you think about the need to upgrade infrastructure, significant investment on the T&D side, but then also certainly the generation spend here is a significant investment and economic driver in the state of Montana as we think about what we have planned for 2022. And then, of course, we think a lot about we need to compete for capital to finance that investment, both on the debt and equity side. So our capital plans for 2022 laid out here across the state of Montana reflect a significant investment here and significant commitment to the state is the way I would say that. So the reason I show you that slide first and think about, the spread across communities and tax base and all of the above is also the part of, as we think about the financial health of the utility, and we've talked about credit ratings before, and we'll talk about that a bit more after this, regulatory lag, things about how we think about making sure we're able to continue the right sorts of investment in the state and be that critical infrastructure provider is making sure we're balancing the financial health and able to do that, right? So as we think about that, a financially healthy utility is critical to continuing that type of infrastructure investment and making sure you don't get behind on that, right? I think about in history of, one of the things that you as commissioners sit in the spot of is making sure we're delivering safe, reliable service that's dependable, all of the above, investing at the right levels, spending the right dollars, getting behind on infrastructure. And you can see this around the US. Once you ever get behind, it's extremely hard to get caught up. And of course, customers from their perspective in the short term, they might think, is that investment just driving up current rates? And my comment would be, maybe that's a short-term view until either a couple of things, one, happen, moments, storms, weather, et cetera, illustrate that you haven't invested enough so far, right? So it was cheap for a while. I would, Crystal's commentary say, Texas gives you a point on that, right? Lowest cost for a while leads to maybe what in the long term won't be viewed as least cost, and making sure you're balancing that. And then ever getting behind on infrastructure, I think about, we think of our service territory compared to many of our other utility peers is, we say more poles than customers. And you have some of our peers that serve millions of people within a very small area, right? So what's our commitment to continuing to reinvest in that infrastructure, and how do we do that? Well, first is maintaining a sound financial health in the organization. The other thing is the slide I just talked about from a capital investment, you see $250 million in 2019, et cetera. I can think about when I first started at NorthWestern in those early years, our total capital spend across both jurisdictions, or including Nebraska as well, was under $80 million a year. So you think about the ability to invest when our balance sheet wasn't strong, those sorts of things, it looks dramatically different than it does today. I also think the utility as we move forward, and we've talked about this broadly, the way we use the system looks a bit, quite dramatically different than it looked even 10, 15, 20 years ago, in the sense that when we're at peak demand from a power perspective, we're importing from out of state what we need. Those transmission lines are working differently than they need to. Our engineers could give you a way better look at that, but the demands on the system, we're hitting all-time peak loads. So that's, of course, customer growth and broader usage. So how does the system perform under those constraints? And I would tell you on the finance side, we think a lot about maintaining a healthy balance sheet, maintaining the financial health of the utility such that we can continue to invest in the right sorts of ways and deal with constraints on the system, deal with peak capacity, be able to serve customers when it's needed most, and do that at the right balance of cost to customers while literally keeping the lights on, the gas flowing. So I just put at the bottom in the sense of, again, how we think about things, because you think utilities don't compete, but we compete in a variety of ways. One, I always think that we compete for our employees. You guys all know that everybody's competing for their employees at the moment. So a compelling place to work and important work is a portion of that, but also we compete for capital from both debt and equity investors and how they think about their investment. And while we're committed to serve here, they can take their capital and go anywhere. So they think about that, and we have to sit in front of them and say, why are we a good investment? Why are we compelling from a capital dollar perspective, and where are we going? So, we spend a ton of time talking about capital investment, but just for perspective, and I know you see our financing applications in front of you, but as of September 30, we had $2.5 billion of debt outstanding. And, that's always usually small tranches where we go out to investors and seek debt, those sorts of things. Our credit ratings are incredibly meaningful to being able to price that debt at a compelling price. And then over 52 million of shares at that time outstanding with a market cap in excess of 3 billion. So that's the area where I think it gets missed sometimes how competitive utilities are with others in the sense you're out in the market competing for those investors to fund your capital plans going forward. So with that, the other thing that we think an awful lot about is balance sheet strength and what that enables. I think there's a couple of pieces to that in my mind as I think through the importance of balance sheet strength. You know, there's the traditional line between strong balance sheet, strong credit ratings, lower cost of capital to customers. That's an obvious point. The other piece that I would point out, which is the left-hand side of this page, is in the footnotes of our SEC filings, they make you say, what are all the commitments that are not on balance sheet that your balance sheet is basically committed to? So a couple of lines I would point out in here is the supply and capacity contracts. That's our PPAs that we signed for our customers. Qualifying facility liabilities, that's another form of PPA. For those of you who know the old tier 2 settlement, that relates to that. But if you look at those two lines, that's in excess of $3 billion committed for our customers of future purchases of power. So what does a strong balance sheet do? Well, all of those entities on the other side of those PPAs essentially financed their business. Think of that as QFs or long-term power purchase agreements off of their having a committed contract to us. So our strong balance sheet enables the ability to go out and commit to PPAs, et cetera, that deliver to customers. So even, you know, if you just looked at the balance sheet, you'd miss this picture of the broader commitments that are driven out of that. And I think that sometimes gets lost, is that significant credit ratings and maintaining them at certain levels is also driving economic development broadly from that. And when I say that, to the right side of the page, and you think of the impact of the utility in the state of Montana. So some of you have seen this information before, but there's a report done by Circle Analytics, which is really an economic picture of the role of NorthWestern in Montana's economy. But you can see the same picture painted for every critical infrastructure utility around the US. But I always think those numbers are a bit staggering in the sense of, you know, over 2 billion of gross economic output. So you think of the impact of Montana of our employees. We also, not only our employees, but we hire a lot of contract work to do sort of specialized work for us, to assist our crews, et cetera, tree clearing, everything. So the amount of ongoing economic output created by our spend in the state is significant to that. So that's also, as we think of our responsibility and how we deliver those broad economic benefits of a healthy utility and infrastructure provider in your state, this gives you a bit of a picture of looking at that in other ways of the downstream economic impacts of that. The other thing that I would say too, and it covers this to the right, but we just talked about our capital plans. We always give a 5-year capital look. That's typical for the industry. You'll see all the other utilities do that. So investors want to know over the next 5 years, you know, what does your capital plan look like? And so when we are speaking with investors, that's a $2.3 billion capital plan in total. So again, as we think about ongoing financing needs, what's that look like? So that's an, yep. No, that's a key piece. So one of the things that your investors will consider is certainly the economic health of the jurisdiction you serve. So you get to customers' ability to pay. And then on top of that, your ability to grow the business organically. So one of the key things that we have, and similar around us, Idaho, right, is experiencing significant growth. Even, you know, I think Eastern Washington, but they look at our customer growth rate and ours is higher than peers. So in that area, from an organic new connects customer growth, we perform very well. So, no, it doesn't. So you're leading to a later part in the deck here. So we'll get to a bit of how investors think about growth in total, because they think about new connect growth, right? So you have new customers. That's, if you're doing better than your peers, that's a great thing, right? And so as I think about organic growth in our financial statements, that's one piece of it. But then the next piece of it is broader, how you're growing investment and earnings. And you're beating me to the punchline that even though our customer growth is higher, our overall growth rate is lower. So that part is holding back our credit rating, certainly. So balancing other factors, but we are definitely going to get into that. So it's an excellent question. You know, it's one of the things that we do talk about in the sense of having a growing service territory. And I really think back to the 2008 economic recession, and you had areas of the country contracting severely. So think around Las Vegas, that sort of thing. And our economies never experienced the boom and never experienced the decline. So there was a consistent growth track record there. That was excellent. As we think about how we sit today, we're experiencing significant new connects. That's a favorable thing to us. Investors, when they get to a total perspective, they look at your total earnings growth rate, which a factor of that is new connects. But broader than that, what's your cash and earnings? What your metrics look like? And so they look at that piece, but then they look at the total, and the punchline is our growth rate is slower than others. But we'll talk about that in a minute. So you're leading the witness a bit. So one of the other areas we'll talk about, so to your exact point of markets are moving differently than where they have been the last decade. And the thing that I would mention that, so when they think about our riskiness and our credit, the question is how much of that do we have that's locked in? So as market prices are going up and you need to serve your customers, we are exposed to the market. And so when market prices are high, we're buying. And so they actually consider us to be riskier because your other peer utilities they're over 100% resource adequate. They own rate-based generation enough to serve load up to what would be around roughly 100%. We actually have a slide on that. We're on the market roughly, call it 40%. So given we're exposed to those prices to procure for our customers and have the Pcam mechanism around that, they actually consider us more risky. So if we had rate-based generation that owned 100% of what is a normal load, they would consider us less risky in a market with rising prices. But given and again, there's a slide we'll get to that will show you the picture of exactly how we compare to peer utilities and how they look at us from a risk profile compared to them. So it's actually credit negative to us because market prices are running high. Our price, of course, to customers doesn't change when market prices change, except for the pass-through piece. And that pass-through piece puts us on the market more and more exposed than other similar utilities are.
So they're looking at cash flows only to the company, and we refer to that. We're going to show you the math on that, and they do look forward. So your intuition's right. Do they look forward, not just backwards? They do look forward, but they're taking our projected cash flows, then they're stressing them the way they stress them, and then they come up with their base case on what they think is going to happen, and that's how they're making their assessment of us. But we'll go through all that. But it's cash flow only. It's not on how you might do in the market and things like that. They have their own view. We have our own view. You probably all have your own view. They take their view, and that's what they run with. But they do look forward.
And it's also, your questions are going right to where we'll cover in a piece of this is how do the outside in view look at us from a risk perspective. And then when they think about our risk, say exposure to market versus others, they're always comparing us to other utilities, right? Because that's the investment lane we're in. So they're not comparing our risk to a tech company or something like that. They're saying, here's NorthWestern, electric and gas combo utility of small cap size, or at least mid cap, $3 billion. How do they compare to other utilities of similar size? And is their risk profile better, worse, the same, et cetera? And so we'll talk about a couple of those elements, and hopefully a couple of these slides will help answer that question. But you're thinking right in the direction that we definitely get questions on. And to Dan's point, the credit ratings agencies get right down to cash flow, and they want to know how that looks for us. And so we'll talk about how they assess our risk as it relates to that.
But
I think now might be a good time for me to share one of my concerns, because it might affect how you present things later on in this. And that is that I had the same question when the Bank of America people called me, the analysts, when we had the Moody's thing, when the utility, the one fellow who evaluates companies for hedge funds and whatever. And that is that it's interesting to me, it really is, to see pictures of the financial strength of your company. It's very interesting, but what I don't know is how that information would influence any of my decisions. For instance, on the disallowance of the coal strip, last one, the one that I was here for, I understood that would cost the company money, but it had to do with what I feel, but the majority, what the unanimous decision of this body was, that it was not fair to ratepayers. That's just one example, a large example. But what I'm trying to figure out is how, knowing any of this about your credit standing and ability to attract capital, what that has to do with any of the decisions that we make. I wanted to share that with you. As you go on with this, that's my primary concern about this. Basically, I look at it as the operation of the company, fortunately, is not in my hands. You guys do a great job. Okay. I admire all the work that you do. I think it's great. I'm glad that we don't have any responsibility for keeping the lights on. You guys do a good job of that. And in terms of business operations, making a profit, whatever, a lot of that has to do with operational decisions, which are not ours on there. So again, I just wanted to share this. This is my thinking. This is the difficulty that I have in trying to assimilate this information into decisions that I have to make here. So
I think that's fair, Commissioner O'Donnell. And the thing I would answer that in one part, and then maybe give you a little bit of overview with where we're going with the deck, and maybe that helps with how does this affect your decisions. When you think about the role of a utility and the reason we're regulated, right, is you as regulators sit in that function of competition, which we don't have. You're not going to run 2 electric lines to your house, right? So if you sit in our service territory, you're a captive customers. So the reason we're heavily regulated is the criticality of that service and the inability of a customer, nor would the cost make sense for, dual electric lines to be run out to someone's property. And you can decide today you want to be so-and-so's customer and tomorrow so-and-so. So as regulators, you sit in that function of competition. So in that function of competition, your role is certainly to provide to the customer safe, reliable service at a fair cost, right? And the other side of that is your role is to support a financially healthy utility, right? So what we're talking about today is your decisions are critical to and significantly impact our ability to maintain financial health. Now, there's other decisions we can make to maintain financial health. They're the sorts of decisions that I don't ever want to be in the position of having to make. And that's cutting critical spending, right? When you say our earnings are entirely in our hands, that's absolutely true. But there's a responsibility you feel to say, I could have better earnings and deliver to shareholders, but I can't do that without, we all the time have to make risk decisions. But certainly the role as a regulator you play is finding the right balance of the importance of a utility to your state, regulating them in a way that is financially healthy, right? So that there's a balance between the two sides, right? You guys sit in that balance. So that's what I would say. Your decisions absolutely impact that. When you think about what you heard from Ryan Wabark on the credit rating side, and there's the quantitative metrics, which Dan will go through, and we'll try to make those simpler because there's a lot in there. But the qualitative side, when you say, what is your role as a regulator? They are absolutely, we can't earn anything or change prices, et cetera, without going right through the regulator, right? So they're looking at half of that balance is the qualitative side of our regulatory decisions credit supportive? Are they consistent? Are they predictable? Those sorts of things. And you see the material that says, so when you ask how your decisions impact that, and without getting, well, I'll get into it. If you look at what's going on in Arizona, I think that's the outside in looking at what's going on with the commission there. I would argue that their decisions have directly affected the financial health of their utilities. And that's the answer as to when you sit in your role and instead of competition, you're thinking about what's the balance between customer and the utility. I would argue that Arizona's got a little off on that. And so investors are basically saying the right answer is take your money elsewhere because that state's too risky.
Let me clarify. I understand that decisions that we make affect the company. What I have trouble understanding is from the opposite direction. How should we make decisions based upon whether it will benefit the company or not? I mean, if we see something as fair, like a 8.6 ROE, okay, and we say this is what it should be. Well, obviously the company would be better off with an 8.7. Okay, but it's almost as if the company is saying, can you give us a little room right in here by not being so accurate, by giving us a little headway? But it doesn't seem to me that that is consistent with our obligations.
Well, I think I can help maybe a little bit what you're wrestling with there. At least I can give you some numbers. When we get to slide 14, I'll show how the cash flow, flows down for NorthWestern specifically, and then maybe give you just some sensitivity towards that might help you out with how it directly affects our ratios and the ratios they're looking at. So if we could just hold that off until slide 14, I think I can give some sensitivity to what you're talking about. At least I can put numbers around them. I mean, I can't make the decision for you guys, but I can tell you what every $10 million of cash flows mean and how much 10 million is to our cash flows. And all that'll kind of show out on slide 14 when I get there.
And just to give you an idea of how to couch things for people like me, I never took an economics course in my life. Okay, I'm a philosophy, theology, history guy. So, I mean, when you explain these things to me, maybe in 7th grade terminology, that might help me to understand. I apologize.
Well, and I think too, that always the answer I would say too, in the sense of, and you referenced particular decisions and you're looking narrowly at this one decision. And we'll talk about in here broadly, if you step back and say, you see our operational metrics, but the other side of that is, are we earning our allowed returns? So we'll talk through that analysis. And that's, to me, always the fair-minded way to step out of the onesie twosies and just look at it broadly and say, our investors expect us to earn our returns. I can tell you we haven't done a very good job of that. And so in the sense of, are you over-earning? Are you under-earning? And this is why, the policy theory of performance-based regulation and putting a band around earnings per se, that's really the bead absent these individual decisions, but stepping back and saying, if I look at the utility in total, they should be earning narrowly within 50 to 75 basis points of their earned returns. And you guys see our Schedule 27s on the electric side, that we haven't been. And that's the line we're held to. And so in the sense of fair opportunity to earn the return on your rate-based investment, that should be to me, guiding force. And again, I'm not the as good at policy things. Our CEO, Bob Rowe, always states it so much more eloquently when you think about the concept of utility regulation and what that should achieve, right? Which is then it's not, is that one decision fair? It's broadly, are customers paying for a fair service? And is the utility earning their return in a fair way? And are utilities or customers receiving the product that they should, right? That is safe and reliable and consistent and delivered in the right sorts of ways. So that's the concept I would put it under. So with those comments, I will endeavor, we all will, to try to make this clear. So the next section, we'll talk a bit about where I've been going, which is investors and expectations. We'll talk on our earned returns and where we've been from that perspective. The next section after that, Dan will get into our credit ratings. And again, we'll try to not make that overly complex and think about that at a high level. And then the last section, thinking about how we are from a regulatory perspective and how we're perceived from a risk side, will be in a couple of those to a couple of Commissioner Panucci's sections. So with that, this next section, Travis is going to speak to a couple of slides here. So I'll turn it over to him.
I feel compelled to explain. Everybody shared how long they're with the company, and I did not. So I've been with the company just about 19 years now. I don't want you to think they picked me up on the way here. So I've been around a little while and been in this room a few times. So it's good to be back in here. Commissioner O'Donnell, you stated that very well. It's how do you balance those interests? And we were just talking this morning about kind of the four legs of the stool: the shareholders, the customers, the employees, and the regulators. And so my role is largely being that liaison to our investors and trying to understand what they're looking for, what we can be doing better as a company to deliver on that, and keeping that all in the context of, hey, what is the best thing for our company, which means the best thing for shareholders and our customers. Because at the end of the day, and we'll talk more about this, as that does mean lower cost for our customers. And we're very lucky today. We have a very good group of shareholders. If you turn to, I think I'm on page 6. For some reason, I don't have page numbers on here. Is that right?
It's 8.
8? Okay.
Yeah.
On slide 8, this is our top 10 list of holders today, and there's a lot of names you recognize on there. Very quality list. 17 years ago when we emerged from bankruptcy, this would have been a very different looking list. We were nearly 100% owned by hedge funds. Hedge funds have a very short window of time in which they're looking to turn a profit. And that forces you into making short-sighted decisions. And out of bankruptcy, one of the short-sighted decisions that was made at that time was putting the company up for sale. And we know where ultimately that went, and we're a better, stronger company today as a result of that, the decision made by the commission here. Today we're closer to 5% owned by hedge funds, and I should state that not all hedge funds are created equal. There are some very good hedge funds. Really, the defining term hedge fund just means generally a company that can go long or short your stock. So in other words, there are some hedge funds that will short stocks, and they make money when your stock goes down, right? So they want to see a company do poorly. So generally, even our hedge funds are pretty good guys and gals, and so we don't have to worry about them too much at this point. Having this long-term focused group of shareholders allows us to be doing exactly the things that Crystal opened this with. We delivered some pretty bad news at EEI by announcing our guidance was going to be lower. Our long-term shareholders are willing, hey, but we do see the opportunity down the road here for growth to get back on track and earnings to resume at the company, and they'll stick around. So we absolutely need and want our large shareholders to stay with us through this. They're massive institutions. We all hear about BlackRock and just sounds like a giant empire, and we don't know what's behind the curtain. But at the end of the day, those funds are retirement funds, pension funds, annuities, individuals investment accounts. It's what kind of makes the economy go around. And so decisions that impact our stock ultimately impact our investors and ultimately trickle back around the circle to us again, as in our pension and retirement plans. Our concentration, we if you look at this list of our top 10 holders, we have, I would say, 350 holders, institutional holders at any given time. Our top 10 holders own approximately 50% of our company. That is not too far out of line. If you look at our peer group, they're closer to 40 to 45% owned by their top 10. It's helpful in focusing a message and being able to work with those investors, but it's also a bit dangerous having we're hearing a lot about activism, right? And a lot of times these activists can come to your list of top 10 and they have been pretty persuasive in convincing that list of top 10 to vote in whatever direction they're if they're looking to get something on your proxy, for example, to pass. So we need to be in communication with these investors all the time and making sure that we have an open dialogue with them as well. We talked about what really is our investors looking for out of this, and it's just fair treatment. Equitable decisions, not every decision is going to be a favorable one. We understand that, they understand that, but they're just looking for fair decisions, consistent decisions out of the commission that realize, hey, they're looking at our four legs of the stool as well and not just concerned about one leg of the stool. when investors are looking at this too, and Crystal, they aren't looking for the home runs. They don't go to utilities for home runs. We aren't the Googles and Netflix stocks. They're just looking for some consistency. Commissioner Panocha.
All right, so use the mic here. I didn't before. So you delivered some bad news.
Mhm.
Did you see your stocks trade or sell, or did it stay consistent after you delivered that news?
Yeah, so the week following delivering the news, we did see a little impact, and I'll be honest, it wasn't as bad impact as I expected. Where the rubber meets the road is when we announced our equity transaction, and they knew, okay, NorthWestern is issuing equity. We were trading around $56, $57. We announced the transaction, and we ended up pricing that equity, selling that equity at $53.50 instead of what we had closed at the day prior to selling, because they know, yep, okay, now we see the dilution coming, and we know that your earnings next year are going to be less than they were this year, and so we ultimately ended up issuing additional shares to get the same roughly 375 million Dan mentioned, and as a result of that issuing additional shares, our dilution is more impacted. So now, even instead of the earnings that we anticipated last year, you end up issuing more shares. So it might take another penny or two off your guidance.
Okay, so I'm just curious, if I was with your company, I would be standing on a desk swinging a baseball bat like Joe DiMaggio at the fact that growth in Montana is so high, you can't even do the connections in a timely fashion, and the price of energy is going up. I'd be selling that. Didn't you mention that?
Well, the thing you got to remember, the price energy, and this is where Crystal was mentioning earlier, is that's a pass-through cost to us. And what we end up actually getting a 10% cut, or shareholders end up paying 10% of that high energy. So that's not good news to them.
How about the highest connection rate
Customer growth is good.
in the state's history? If I was a creditor or looking at your credit rating, I'd be asking you, if you can't do these connections in a timely fashion where somebody has to wait 5 or 7 weeks, that would be a concern. I'd say step that up a bit. But you guys got to be looking great with the record growth in Montana. Didn't anyone mention that?
Well,
with the bad news?
That has to translate to earnings before they care about it, or before it benefits us, right? And so that, yes, that is an additional customers, hooking up additional customers. That is absolutely great, and it's great for the state.
At a record high amount.
Yep.
You serve other states. Is the record growth in Montana a leader compared to the other states you serve?
Yes.
So
Montana's growing faster than other states, at least the areas we serve of our states.
Really is an asset to Northwest Energy over other states. Is that fair to say?
Yes, absolutely. We are very happy to do business here. We're proud to do business here. But we just have to be able to, and we'll also talk about this in a bit here, is we just need to be able to have a timely recovery of all the investment we need to make for all those new customers. Because until we start getting recovery of that and it shows up in our earnings, it's a detriment. And rating agencies see it as a detriment, and our shareholders see it as a detriment.
Well, when I buy stock, I look at growth, and you guys are going nowhere but up. So I'm just thinking.
Well, and you're actually a great lead in for the next slide.
Okay.
And the next slide looks at that, because we communicate what our growth rate is, and we're not unique in that. So I'm on slide 9 now. Slide 9 is a slide just put out very recently by Wells Fargo that highlights the communicated long-term growth rates of utilities across the U.S. We communicate a 3 to 6% earnings per share growth rate. You'll see where we are on the list in comparison to the rest of the utilities across the country. Okay, we do not have, if you look at what it takes to finance the capital investment that we're making and the regulatory lag that we have built into rates today that allow us to get recovery on that, we have to finance that finance that investment with debt and equity. And so you get dilution. We do not get that. Earnings growth does not show up for a long time after we make that first dollar of investment. And we have a slide on that too. And so when as an investor, if you're making a decision on a company that says, well, hey, I can grow my earnings at an average of 7, 8, 9%, or Northwestern can grow their earnings at an average of 3 to 6%. As a logical investor, which one are you going to choose? The one that has a higher growth rate, right? And this is we're obviously it's our best interest to tell the best story we absolutely can. And so, but it's the news out there. People do know that our growth rate is lower than the rest of the industry. And it's because it's not purely measured by how fast our customers are growing. So, and you might also, the last thing I guess I'd point out on this slide is that you've probably noticed too, there's 3 companies out there that have a little bit broader range on earnings guidance. We say 3 to 6%, so 3% from bottom and top end. There's only 3 companies on this page that do that. We unfortunately, just because of some of the unpredictability in our investment opportunity, whether it be in generation and then our regulatory lag and lack of mechanisms, that's why we have to have a little broader range of 3 to 6% versus that kind of 2% that our other utility peers have. And so that just adds an additional element of uncertainty from our investors' perspective.
Travis has talked with you about who our investors are. I don't think any surprises there, but ultimately behind those investors, as we think about them, it's everybody's 401k, your IRAs, everybody's retirement planning, pension funds, those sorts of things. That's truly who our shareholders are. And that's who we want to keep it as, right? Is long-term, you should own a utility. They deliver consistent lower growth, right? Not what other industries are going to be, but a solid dividend return, highly regulated. That's the type of investment you're looking at. But then when you stack us against other utilities you could invest in, so I would, Commissioner Petochi, to your customer growth rate, you'd compare NorthWestern Energy Montana to IDACORP in Idaho, right? They're seeing extreme population growth, the same struggle with keeping up with new connects, with the same crews you've always had, all the above. Yet their earnings growth range is in the top part of this and ours is in the lower. So how that translates and how quickly it translates to earnings growth is really what the investor is looking for. So you got the opportunity. So how do you translate that into actual earnings that drive investor return? So the other thing, that we mentioned is how does NorthWestern, you asked how our news of 2022 and lowering earnings for a year, which is not what's expected. We're expected to have increased earnings every year. How does that affect? I would tell you much of that was already priced into our stock. And Commissioner O'Donnell, you mentioned you spoke to maybe Julian or some of his folks at B of A. And what they would tell you is we have a discount to our peers that we trade at. And so that discount reflects that in the next slide I'm going to get into, we don't earn our returns. Our growth rate is lower. Those are the 2 things they're going to look at and say, well, we're going to trade you and value you at a discount. So then when we go to the market and we needed to issue equity to fund the infrastructure we have in front of us, we have to issue more shares to get the same dollars, right? Because we trade at a discount to our peers. And so that's the part where, when you say keep it simple, and we tried to, there's PE multiples and all the kind of technical trading things people will get into. But really what that simply says is they're willing to pay less for us and they're paying a discount for our equity because we traded a discount to peers due to that growth rate. So how does your customer growth and your rate base, right? Really the only place we earn on is a return on rate base, the classic regulatory model, right? So how does that stack up against your peers? And we don't stack up very well. So slide 10 gives you another view of why we don't stack up very well. And these are the reports. This is our electric Schedule 27 filings. And so investors, what do they expect from us? Consistent growth, right? Commissioner Petochi and alluded to that. When you're looking at stock investment, you look for growth. And then the second piece of that is they expect us to earn within 50 to 75 basis points of our authorized returns. And so if you look at our earned ROEs and then normalized, and Andy could speak to more closely what the adjustments are to normalizing that, but on either regard versus our authorized returns, if you think of our last electric case authorized at 965 and earning at much lower than that, investors discount us because of this growth rate and our lack of earned returns. That earned return is definitely driven by, things that may happen during a period. If you look at the COVID year, certainly significantly driven by loss of load during that period. But then the second piece of that is how quickly do you turn your rate-based investment into earnings, right? And the amount of regulatory lag that we have is substantial. We've talked about this, but we communicated to investors, we expect to file a rate case in Montana next year. And certainly what they're sticking with us for the short term. Some of them just bought us at a discount. They're hopefully, I think they will do well in the long term. I would like to think so. But the next piece of this is they are expecting us to get back to earning close to our returns. Commissioner Fielder.
Thank you, Mr. Chairman, Crystal, and the rest of the team here. I have a question. As you're talking about investor standards, has this notion of ESG standards impacted any of your investment criteria yet? Are you feeling that? And for those that might not know what I'm talking about is.
I'm going to second this line of questioning because I was going to ask it.
Yeah. So this is environmental, social, and governmental criteria for social conscious investors. And I understand there's a real squeeze through some being applied through some financial institutions to cut off investment opportunities for companies that are involved in any kind of fossil fuels or any kind of mining activity or anything like that some people feel is morally wrong to be able to utilize and be stewards of our natural resources. Are you feeling a pinch from any of that yet? Are you seeing it?
So Commissioner Fielder, Chairman Brown, answer this question in two parts, and then either of these two can pile on because I know they both have seen this in multiple regards. So Travis deals with the equity side. Dan deals with the credit rating side, and our credit ratings agencies have just come out with ESG standards and the debt side, and they can give you particular examples of what we're seeing. So one, if you looked at our investor slide deck, you would see an ESG section. That's just table stakes at this point that we have in there with our investors, where we're at from an overall portfolio standard. And then how we think about the social and governance part of this. Certainly, I think we've always done well from a governance perspective. It's Crystal's viewpoint. I think from a social standpoint of, the types of employees we have, living wages, those sorts of things, right? We largely have skilled labor. So we're not retail employers. We do very well on that side. We offer comprehensive benefits. We're highly involved in our communities. And so that's something that's just, to me, also table stakes about being your local utility, but maybe different than other industries. So the S&G part, we talk about that. On the environmental side, we talk a lot about our portfolio. And of course, that is viewed differently through different lenses. One of the things we talk about is the nature of our carbon-free portfolio and how hydro is the bedrock of that, and what an incredible asset that is to be dedicated to customer service. So that puts us, many utilities have their targets of where they'd like to be from a carbon-free portfolio. When you look at ours with hydro as the base of that, we're already better than others from an ESG performance. The concern I have there is many times it's more about where you're gonna be and what your statements are about the future, and less so what you're delivering today, regardless of the degree of caveats. I think there's also certain investors that have been with us for a long time who they've all added ESG standards to their investment screening that continue to be with us and make the case that we're doing the right thing, right? The first part of reliable service at a fair price and managing what is an already more carbon-free portfolio, that we're doing the right thing and they're sticking with us. But certainly the screen of owning coal at all is becoming more of that conversation. So Travis, I'll let you answer how much we speak to the ESG side on the equity side, and Dan, you can pile in on that.
Yeah, thank you. So I would say starting maybe 3 or 4 years ago, when you went to conferences, that's when you just started hearing about ESG all the time. But it certainly has a trickle that's gotten to be a much larger roar amongst investors. And so we're really working hard around the disclosure of data. That's one of the biggest pieces, is they want to at least see that, hey, utilities and companies are willing to lay their cards out so we can see. I always think it's very hard, especially on the S, right? How do you disclose a culture of a company? We have a wonderful company here, but how do you put that in words and make everybody understand how good a company it is to work for? And some things are more easier because they're quantitative, and we can talk about our 65 or almost 70% carbon-free portfolio. But I definitely see it coming more. We're trying to juggle the kind of understanding which entities are going to be the leaders of doing the rating, because there are so many different entities out there that are providing ratings of companies' ESG activities. And it's very difficult to give everybody what they're seeking, all the disclosures. So we're really just trying to manage that. We understand our first obligation is to our customers and providing a portfolio that will deliver the energy they need 24 hours a day, 7 days a week. And so it's one of those things. I guess I would call it currently the sizzle on the steak. I heard a reference to the other day. Is it's something that as a utility you need to be thinking about, and it makes us more attractive if we can demonstrate that we are at least disclosing data and transparent.
Yeah, a couple, so I'll talk from the credit standpoint or the debt investor standpoint. Our debt investors tend to be insurance companies. So when Crystal talked about having a little over $2 billion of long-term debt outstanding, those tend to be insurance companies. And then the other bucket that we deal with is on the revolving credit facility side. Those are banks. And so a couple anecdotal stories here. The last time we raised some debt that had some tenure on it. When I mean tenure, the length, the maturity schedule, we did 10-year paper in a couple of years ago, and then during 2020, when the coronavirus hit, we went out and got some more shorter term debt, but it was with the same cast of characters, and we were getting questions, and we had to go to separate committees that we hadn't had to go to before at these insurance companies just a few years prior to that. And so that was the first time we kind of really ran into it, because we were talking about, well, on the governance side, there was I think it was Moody's put something out, and we were the fifth best utility on the governance side. And we had to go to a separate committee because of our ownership in Colstrip. And, we had explained to them that, Colstrip's own a pretty small percent of our portfolio in Montana. And we had to walk them through all those steps. So we got them there, but we had to go to a committee we hadn't had to go to before. And then just when we did the revolving credit facility last year, we did a 3-year revolving credit facility. We'll have to do it again next summer because it'll once you're within a year, you want to do it again. So anyway, when we went through that process, we had to go through 3 or 4 more hurdles that we just never had to go to before with our banks, and it was all around the carbon side of it. So. And I tried to ask them, it's like, well, what's your threshold on when it's too much? Because Crystal mentioned that, we're already more carbon free than a lot of our counterparts, so we feel picked on a little bit, because, why do we have to improve if we're already at a threshold that's pretty good? And it seemed like at the time, about 25 to 30% where there were some of these banks were looking pretty hard. So the bigger banks, it'll be interesting to see next summer when we go through this process, how much that bothers them, and to see if that threshold moves down again. Because it was pretty interesting to me, because we never, Travis made the comment 4 or 5 years ago, you never heard about it. And that was exactly right. No one asked us one question 4 or 5 years ago. And now recently we have extra committees to get through.
Yeah, thanks, Mr. Chairman. I think we're going to be hearing a lot more about it. I just watched a little news show about, I think there's 14 state treasurers now who are pushing back on this by not investing state funds in these financial institutions that are pushing this ESG stuff on companies. So, on the insurance side, I think the states could do the same thing with insurance. There's some pretty big assets there if several states join that effort to push back on that. So it's something, if you don't have it on your radar, you might want to put it on your radar.
I would just note to my colleagues that I have already talked to staff about putting on a presentation for ESG in 2022, if this is something my colleagues would be interested in. So I just want to put that on your radar.
My follow-on comment to that would be, one, we've done quite a bit of work. There's a couple of these ratings groups that are formalizing. Our scores were poor in certain areas. You would think our social score, I laughingly say, I probably shouldn't, is we must traffic children or something. So it's just getting the data right. They scrape your websites and it wasn't correct. Travis and another gentleman that works for Story have done a lot with a lot of other people, a ton of work just around just get the data right if you're going to score us. And so there's been low hanging fruit and our scores have literally improved simply because the data is correct now. We're not doing anything different, that sort of thing. The other thing about ESG and on your radar, Commissioner Fielder, is there had been a Department of Labor rule under the prior administration that, 401k plans, that kind of thing, you cannot consider ESG in the option of investments you offer, right? So think about Vanguard owning us, BlackRock, what's behind the scenes. Those are a lot of those types of investment. Well, that ruling has changed. So it used to be it had to be returns growth only. And now ESG can be considered. So as we're navigating these waters, certainly we don't want any of our investors to leave us. We want them to understand our story, but it's that balance of reliability, affordability, and then the carbon piece of that. And at this point, there has to maintain a balance on affordability to customers. I don't understand how you don't consider the social part of that piece of it as well. And so where this goes, and Commissioner or Chairman Brown, as you're thinking about this, it's really developing waters is what I would call it. And it's been developing in our banking relationships. And if you've paid attention to the news lately, a lot of the large banks have statements on how they're going to think about lending going forward. And of course, we think about access to capital in that regard. And then also the screens with which our equity side will be on. And so we're kind of front row seat seeing those waters change a bit. But to Travis's point of the sizzle on the steak, I like that one. The steak is this slide. So we talk about ESG with both sides of investors up until the point where your earnings aren't what they would expect them to be. And then it really is earnings, right? And so this ability to earn our returns, I would tell you that's the stake. And that's what investors, when rubber meets the road and they're looking for returns on their investment, this is what they're looking at. And benchmarking our ability to stay close to our authorized returns to other peer mid-cap utilities. And if they are doing it better, they'll invest over there. So with that,
So maybe just to add a little bit more color on the very last line, or the very last columns there for 2020, mainly because Commissioner O'Donnell brought up the coal strip disallowance. Just wanted to point out how these numbers are kind of represented. The coal strip disallowance was reflected in our 2020 financials, so it would show up under that dark blue line, but the light blue line is the more normalized numbers, which is ultimately what we did earn as far as our return on equity, as far as kind of the normal operations of the business, assuming normal weather, what that would be. So that's kind of the differences between that earned column and the normalized column, just in case you had any questions on that.
If I may, I think for the listening public, one of the misunderstandings perhaps is authorized ROE. It is often referred to in the public as a guaranteed rate of return.
I wish.
So could you clarify for those who may be listening what the distinction is?
Yeah. So if you look at in this graph, slide 10, if you look at the dotted line at the top, that is our authorized ROEs. And then you look at the bars on the bottom of this chart on either a earned, broadly no adjustments, or normalized, as Andy alluded to, whether that be individual items during the year or weather. If that were guaranteed, every one of those bar charts would exactly meet that dotted line. And what you see is we are earning less than our authorized returns in each of, you can see only 4 of these years have we actually hit our authorized ROE. So in the sense of a guarantee, the only way I could say that would be a guarantee, and we do have a slide coming up on kind of the regulatory compact in theory, which would be you never invest more in the system than your depreciation allows, and you never give employees a raise, or if you give employees a raise, you cut costs elsewhere, kind of a thing. That'd be the only way in a perfect guarantee that I think you could hit that. However, there are other rate making structures. A key piece of this is certainly regulatory lag. We'll get into that. If you look at the bottom of this slide and see the increase in our investment in the state. And so, Commissioner O'Donnell, you asked, as commissioners, how should we think about this from a regulatory compact? And I would tell you, the bottom tells you we're continuing to invest in infrastructure. We're investing in the state. We're managing that. But meanwhile, that's driving regulatory lag. And then if you look at the top part of this, if we were hitting above that dotted line, and you can see commissions around the country, they pay attention to that very closely. And that's when, in fairness, you would probably call us in for a rate case and say your rates are too high. But when you look at our track record and back to how investors think about us and the stake part of this, so what do they look at first? They look at these earned returns and the conversation with them when we tell them next year is a down year because we're issuing equity, it's diluting. Their question is beyond that. Are you going to get back to being close to that dotted line? So it is certainly not a guarantee, Commissioner Pinocci.
So we talked a little bit about carbon. When I'm at NARUC, I have other commissioners say, wow, Montana, 70% carbon free. I wish our state was that way. We recognize that a little bit. A few months ago, I introduced a docket on energy efficiency. NorthWestern Energy installs a high efficiency line in Monarch, which cuts carbon. NorthWestern and the Public Service Commission jointly did an article together. $440,000 a year in savings from line loss. Now, if I were you, I'd be talking about that. I'd be trying to explain that our 70% needle just moved a bit. The reason people invest with NorthWestern Energy is because they're looking for security. The dollar is in great danger of devaluing. People are worried that it's going to absolutely fall apart. And if you're going to invest in something that's risky, you have a chance to make more money. But if you're looking for security where I can trust that my retirement's going to be there, this is a better bet. But why wouldn't you talk about that article? The other day I was in a NorthWestern Energy meeting in Great Falls, and none of the employees were aware of the article we did together, where that the savings was $440,000 a year. And that does cut carbon. If we can reduce line loss, that's no different than taking cars off the road, but you're really not squawking about that. And you should be. More importantly, every line replacement that you do should be a high efficiency power line, cutting line loss by a third. And there's more. Your fire mitigation, I believe, is cut in half. Insurance companies should be lining up with a credit to your insurance bill because you're installing lines that cut fire in half. Just got back from a meeting in Denton, Montana. If the high efficiency line had been installed there, would the fire have happened at all? Probably not. But the point is to skin the cat a different way and to go back to the investors and talk about we're going to make our needle move a little bit more. And what did you say about the banks? I want to see 25%, maybe not 30. They get more excited about that. Could our credit increase if they understand these high efficiency power lines are going in? Of course. The payback at $440,000 a year is based on the line load going through there now, which could double or even go higher because we overbuilt the system. The savings could easily be over $1 million a year once we get to capacity of line load. But what if we started replacing 3 lines? 1, any line that is brand new should be high efficiency. 2, any line that has to be replaced should be high efficiency. And 3, and this one's important, any line at capacity which has to be upgraded. The high efficiency power line doubles the capacity without modifying the structure. In other words, the same size power line carries twice the electricity, and we don't have to change the power poles. Those 3 things, if you were to commit to that and explain it to your investment companies, our carbon goes down every time a line is installed. And the investors should say, for the long term, this is a safer bet because this power company made this commitment to the high efficiency power line. Sitting on the National Board of Electricity, I'm trying to get that done across the country. But I go to NARUC training in rate school. And they're not even teaching that properly, that line loss formulas can change by a third. That is no different than cutting carbon. And you have to explain that you're doing that and you've accomplished that in Monarch. And then if you do that with every project, what if you did that with the next 100 projects? It'd be in the millions. Your carbon meter would have to go more into the green and you have something to talk about. But that kind of commitment, they tell me that this docket I've introduced is only 2 in the country. You guys could be a leader on that. Take that to your investors and explain that we're cutting carbon by installing lines that cut line loss by a third. How many lines would have to be replaced where the savings is so great? We've just added a generating station. I'd be knocking myself out trying to figure that formula. And if I could reach that goal, we together, the commission and NorthWestern Energy, could say, we've just installed a power plant with what we saved in line loss. And it's obtainable. It absolutely is. Pcam Reservoir needs a generator. Let's get it put in. Let's go to the legislature and say, if the transmission line's the problem, ask the legislature for that. I will stand with you and say this. If we get Pcam with a generating station installed, I can prevent us going to the open market paying 10 times more for energy. And it's green energy, it's renewable, and it's carbon free. I have a dam at Gibson Reservoir that was designed for a turbine that's never been installed. Greenfield is looking for a partner. They want to install it immediately. These are just some ideas that gets us more carbon free, and we should reach that 25% that the bank's looking for, and in a way that no one else is really looking for it. And I'll stand with you on that. And legislators are excited about what I'm teaching, and they'll stand with us too. And I want you to know that. Thank you.
Appreciate that, Commissioner Pedocci. And I know you're working with the operational side of our folks on the transmission side. And certainly in the carbon equation and managing load growth and efficiency, all of the above answers are important. So, and I know you spent time with, I think, Mr. Cashel, and he's the one that knows our lines in that regard and is can answer those things better than I can, but I take your comments. Just in maybe concluding this section before we transition into kind of credit metrics, just on stock performance, what you see here is, again, we benchmark ourselves to peer average. So if you look at the bottom graphs here, we are in the red. Our 12 peer average is to me, the most directly relevant comparative. And this is other mid-cap utilities. So we started talking about perspective of where we sit. $3 billion market cap is really pretty small, even though it feels big. And then we compare ourselves to other similarly sized utilities. And what I alluded to in the technical equity valuation is we traded a discount to our peers. And this, you can clearly see what these graphs show you at the bottom is on a 1-year total shareholder return, 3-year, 5-year, and 10-year perspective. We lag our peers, and that's the growth rate issue and regulatory lag piece. So that's how we stack up to other utilities and what they're earning on their returns compared to us. So with that, the next slide is just that high-level regulatory design. When we think about our earnings, all of our profit is really that return on component of rate base, right? So when we come before you and bring our rate base before you to earn the return on that, the rest is pass-through, right? Our pass-through of O&M costs, pass-through of property taxes, that sort of thing. Where we earn our profit is our return on rate base. That's the regulatory compact. And so what this is showing is as our rate base grows, you should expect to see our earnings grow as well. And that's where we had the slide that Wells Fargo put together that said, these are the growth rates that other utilities have communicated. NorthWestern's on the very low end of that. This is that hypothetical kind of model of if we're investing in rate base, that's the type of growth they expect it to see, to be linear with that rate base growth. And again, I know you've all been to the rate making schools you just alluded to at Commissioner Pinocci, and so they walk you through that. But sometimes when we talk about NorthWestern's profits, just to be very clear on that, the only profit we have is earning a return on our rate base. That's the regulated model, and that's the business we're in. So with that, Dan, I will turn it to you to talk about credit metrics.
Okay. I'm going to go to slide 14. I'm going to go to slide 14. The next couple slides I'm going to talk about here are going to talk about some of the numbers that are related to us. The first slide is going to talk about the rating agencies. There's 3 rating agencies that rate us. We got S&P, we got Moody's, and we have Fitch. You guys heard from Moody's a couple weeks ago. Ryan came and talked to you. That's the bottom graph. The top graph is S&P. And so the top 2 pie charts, what those are showing you here is that in 2012, S&P had their portfolio of companies basically between BBB and BBB minus. Over the next 8 years, as consolidation was occurring in the industry and the companies were just scaling larger, you had heard that the rating agencies, have very formulaic calculations, and then they have kind of qualitative ways they look at companies. And they like scale, diversity, multiple states, different things. And so over that time, what they did was is several companies were shifting from BBB flat, the brown box on the left-hand side, into that light blue BBB plus. So maybe I should take a step back. It's kind of like grades at school. A is better than B, which is better than C. So BBB flat, is not as good as BBB plus. So they morphed about 5 of those companies into that category by 2020. And then a few, the companies that were BBB minus went from 6 companies to 2 companies. And we believe, we don't have all their data, but we think that they probably moved into the BBB flat category. So basically over the last 8 years, their portfolio of companies have improved on their credit ratings. And, a lot of times when you talk to investors or, they ask you questions like, what keeps you up at night? And what keeps us up at night is, we don't want our ratings. If you look at that Moody's, we're at BBB, we're at AA or Baa2, which is the equivalent of BBB flat. So, some of their lettering sounds very sophisticated, but when you just break it down, that's the same as BBB. And Baa1 is like BBB plus. And so, it's really just think of it as the way, S&P calls it. It's just easier to get your head around it if you're not in the finance industry. So basically Moody's has us at BBB flat. S&P has us at BBB flat, and Moody's basically has us at BBB flat with that Baa2. But Moody's has put us on credit or negative outlook. And so what that means is we have about a year to 2 years to get out of the negative outlook. And the way you resolve that is you either move down and become stable, or you stabilize and stay where you're at and become stable. But they won't let you sit at that negative outlook for very long. So we do have a little bit of time here to improve how they're viewing us. One of the ways that, we can manage the company, and you probably read, or maybe we talked to you a little bit about the equity rate, the stock, that we just raised. So on the next slide, I'll get into the numbers. But before I do that, I just want to tell you that if you have more equity, you have less interest expense. And if you have less interest expense, there's less pressure on your debt. And so we sold stock to try to improve, as a way to try to improve and get off this negative outlook. And in the last couple of years, I gave you some anecdotal stories about we've been raising debt. And if you look at the last, was it 2018? I'm pretty sure I'm right on that. We were going to raise, about 50% of our CapEx in debt and about 50% in equity. But what we've done is we've only raised about $100 million of equity or selling stock, and all the rest of it was debt. That's put a lot of pressure on our numbers, which I'll get to on the next slide. So in order to rectify that, what we did is we went to the market last month, or in the last month, and we sold about $325 million of stock. It was oversubscribed, so we sold about $373 million of stock. And the way to kind of manage how it would affect the cost to the customers is we did it in a forward feature. So we took down 75 million, which we needed in liquidity right away, and then over time with our CapEx, we're going to draw down on the stock that we'd sold forward. So the stock is all sold at the same price. We don't have any risk of it going down. And we're going to draw on that. And so what you're going to see in the next year or so from us is that we've resolved our capital needs by doing this offering. So it did two things. It took care of our capital needs for the next, year or so. And I know it came up when we did our shelf registration that there were questions, why were the numbers so big on that page? We were still in the summer trying to figure out we're going to do debt, we're going to do equity, we're going to do a combination of each. And so we had to have buckets for each one of those. I do want to assure you guys that we're not going to spend all that money that's on that shelf. We were just trying to figure out what we were going to do here. And this is what we did. We raised the equity. And the reason we did it was to help out on that bottom slide that you'll see up there to try to keep Moody's at that BBB flat category. So with that, unless there's questions, I'll move you to the next page and we have questions. Commissioner Panucci.
Okay, so the ratepayer is dying to hear this one.
Yeah.
Let's say the commission makes decisions here to increase your credit rating.
Okay.
Does the ratepayer pay more for their rate? Or can I do some decision here that would lower the rate and improve your credit rating? Or any decision I do to improve your credit rating is going to increase the rate? Could you answer those two questions for everyone?
Yeah, so the rating agencies are going to look at cash flow. So we need to improve cash flow to improve our debt, our FFO to debt ratio. FFO is just kind of fancy talk for your cash flows. So the operational cash flows, if they go up, that ratio to the amount of debt you have improves. If your cash flow goes down, that ratio gets worse. And that's the ratio that the rating agencies are looking at. So what we need to do to improve that ratio is improve our cash flows. Crystal talked about there's other ways to do it. We can cut costs. You got to figure out how to get more cash flow. So, to answer your question, is there anything that you do if you reduced rates? If it reduces cash flow, we have to come up with some other reason to increase that cash flow to get it back. And in fact, what you'll see on the next page is we're underneath the threshold on cash flow to debt that we have to improve that. And that's on our company. That's on us as a management team. We got to figure out how to do that, but we got to improve that cash flow. And so anything that's a detriment to cash flow just makes that delta even higher.
So my question is still this: is there any way to improve your credit rating and lower the rate to the ratepayer? The answer seems like it's no. Is that a fair answer?
If cash flow goes down, it's worse for our credit ratings.
Now I have a ratepayer that believes he has an answer that says it can be done. And I'm going to take a shot at it, and I may not explain it as well as the ratepayer did. Here we go. Electricity comes in different prices. Solar may cost more than wind. Wind may cost more than coal. It could be argued, because you don't have to buy coal and get rid of the ash and haul the coal, that wind is cheaper when the wind is on, but when the wind is off, then it's more expensive. So if we would focus on what the cheapest electricity was, which we believe is nuclear, and let's just say for a second that it is, and we put that nuclear power plant in, then the price of electricity is cheaper to make than other forms to make it. So they believe that if you would just focus on the cheapest way to make electricity while keeping your rates where they're at, then your cash flow goes up and their rates don't go up. Now, this kind of makes sense to me. And one thing no one talks about that I think we should talk about is that electricity is a different rate depending how we make it. And which one is the cheapest? Okay. I have it argued all the time that wind is cheaper and everything, but then when they sit there at the same desk you're at, they ask for a rate that's higher than anything. Okay, the ratepayer is asking me this, give me the cheapest electricity. Let's just generate that. Keep the rates the same. The profits go up. Your rating goes up. Their rates stay up or maybe even drop. Is that a fair point of view from my ratepayer or are they out of line?
Yeah, Commissioner Poche, I'll take your question and answer it in two pieces to this. So, right, when you think of our total rate, you're paying for transmission, for distribution, and supply. So you're talking about, in this, for instance, of what could be credit positive to NorthWestern of could the rate lower overall while NorthWestern does better? And I would say, regardless of the conversation around which sources are expensive at which times, which is a critical piece to that, that literally has been our story of we were able to grow the company, deliver returns because we took out a portion of supply that was passed through, owned by someone else, right? We're paying other providers. They use our balance sheet through PPAs. So if you think about pass-through PPAs, NorthWestern owns that, right? In rate-based generation, think of the hydro assets, other assets we've brought through. So customers are still paying for it, but now we earn the return on. So that's credit positive to us. It's not to someone else who, by and large, have higher returns than we do. I don't think you're going to see any of those types of facilities signing up for a 9.65 ROE. I don't know what their financials look like. I would guess it's double that. So your question was getting into narrowly nuclear versus other things, but one of the ways we've grown this business has been good for investors. I think good for the state of Montana is reintegrating rate-based generation. Now, the question then gets into what's the price at certain times versus what's the price of all the time and the operating lease versus buying it, right? Rate-based generation is like a mortgage. Once you pay it off, you have that asset, right? Versus what we're doing with PPAs is basically paying a lease of a long term. So that would be my example. And I think kind of where you were going in the sense of owning an asset that's less expensive and taking out a portion of that bill, customers continue to pay for the supply portion of their bill. We've grown the business through taking out a piece of that and owning it. Think of the hydro transaction, et cetera. That was definitely credit positive and neutral. In fact, our bills overall have come down over time. So I think that's a critical part. The part I would be remiss to not say is that many of the measures in the sense of where you sit in that balance between us and customers and fair regulation is in the sense of what Dan's alluding to is the cash through our rates. That to improve our credit metrics at this point, we have to do two things. We have to use equity, which is more expensive than debt by and large. And two, we have to maintain a line of financing our future capital and maintaining that balance and have to have cash and rates that services that. And many times that cash and rates, and as a regulator, you're pushed by, from a customer perspective, it's always probably easier to make the decision short term for customers is either you don't have to pay for that or lower rates. But your role is the long-term view of rates will likely grow at some level over time, but are you receiving a fair service for that? So your question of, is there an example where you can improve our credit metrics and not have cash flow? In other words, bills increase. Many aren't that option, but the option of trading out a portion of the bill for something else, what we've done exactly on the reintegration of supply, I would tell you is an exact example of that. It's been credit positive to NorthWestern, provides ownership in the state of Montana, and has taken out what was paid through in PPAs.
That's better stated, but I would just summarize, what I think you just said, Crystal, is that, if we can take pass through rates that go to the customers, shift them to where we own them, and if that can be cheaper than what the customers are paying, that would give us more cash flow and, others less cash flow on the market, that would help us out. So what I have on the screen now is the cash flow from operations, what that CFO means. So I realize you probably can't read that, and if
These are in millions, by the way.
yeah, so I think Crystal would be really happy with that amount of money. But so cash flow from operations is just really, I know these numbers are small, but I tried to demystify, where all these numbers and things because we talk about FFO to debt, which is in the middle of that page. The rating agencies want us at 14%. and we're at 12.5% at the end of the year. And it's calculated by taking our cash, and what you're looking at up there is the audited financial statements. So we just take the number straight off. They take it straight off the financial statements. They take off working capital, which is accounts payable and things like that are on the left-hand side of the page, and they adjust for that. And then you have something called funds from operations. So you take that and divide it by the debt that's outstanding, and that gives you FFO to debt. That is the primary metric that they're looking at. And I know I said I'd give you some sensitivity when we got to this page. So about every 10, given where our debt's at right now, every $10 million of funds from operations moves that ratio about 40 basis points. So 10, if you could move FFO to 304 million, if you could move that to 314 million, 12.5 would become 12.9. Conversely, if it drops, then the 12.5 becomes 12.1. Moody's wants us at 14% on that 12.5, and it's like basketball, not golf. Higher's better. So we're underneath the threshold that they want to have us at. So when I talk about cash flow and things like that, we have to, whatever we do has to manifest itself into cash flow from operations. And it's just a pure calculation that they do. Now, I know when Ryan was here, he talked about, a lot of different ways that they look at it, but when it boiled down to it, 75% of it was, regulation, how they look at regulation and in these ratios, and then 25% of it was just general factors like scalability of the company, diversity, and things like diversification of earnings over different states, things that moderate your risk. So they're highly quantitative in their analysis. So what we got to do is we got to move that number that says 12.5 up to 14%. And here's where we get the numbers. So you can have it for reference to look at later. Maybe it's hard to read, but it's not like, it's not that difficult to come up with these numbers once you get our audited financial statements. So hopefully that, makes less mystery to all this when we talk about some of these ratios. Moving to the next page, then how does 12.5 for us compare to our utility peers? So we have our 12-member peer group that the board judges us against, and the blue line is where they are. The red line is where we are, and basically since the tax act of kind of the Great Recession caused some or basically the tax rates coming out of cash flows affected everybody. So we've all tilted down a little bit over that time frame, but you can see that we've kind of tilted a little bit lower. And the reason we've been pushing more debt than we have equity with our ratios. And so that's probably kind of driving this. And that's why we tried to rectify that. And so once we fell below that 14% in 2019, when we got to 2020, we dropped all the way to 12.5%. Moody's indicated us, and so the other rating agencies, that they would look through 2020 because that was an odd year with the pandemic and things like that going on. But if you go to the next page, and this is where I was getting at, they do look forward. So they don't all automatically just look backwards. So we give them projections going forward on what we think we can deliver. And then so the light green line, or the lime green, the straight line that's at 14% is where they want us to be. The blue line that's above that, or the darker green line, is the actual. So we were above that until last year, and that's what captured their attention. So then they had a couple of add backs, that blue dotted line that starts in 2019 to 2020. They gave us some credit for some things that happened because of the pandemic, but they were, we were trending the wrong way, and we were definitely underneath that line. Then we gave them projections, and then they run their own base case. So that's not necessarily our numbers, that dotted blue line there. That's numbers where they look at our, they might look at our growth rates. They might look at different things that we have in our model. and then they have their own view on what they think is going to happen. That's that dotted line. So they think we're going to take another year before we bottom out and then start clawing back. And they're really looking out in that 2022, 2023 timeframe for them to make their decision. And so, what we have to do is we have to deliver something to them better than this dotted blue line that does start tilting the right way, but we have to deliver something and convince them that we're going to deliver something better than their base case so they don't downgrade us. So that's what this chart's indicating.
So it's, as Dan's alluding to there, and annually Moody's looks at our projections, and through data requests end up filing some of that. But certainly what they're looking for is the next time we get together, you heard Dan say we issued equity to help support as we're financing infrastructure going forward. They will like to see that, right? Not pushing more on debt, but using equity in that regard. And they'll also be, I will tell you, looking at our next rate case very closely as to the outcome and direction of that. That will be the next significant regulatory piece of that. So with that, I'm transitioning to our last section here. I promise I think we only have 3 slides left. You've been very engaged and listening to all of this all along. So we certainly appreciate that and the active back and forth conversation. So this piece of and I think Commissioner O'Donnell earlier asked the question of your role as regulators and how do we think of this balance between the financial health of the utility and certainly decisions we can make as running the utility and you as regulators. So this is a bit of that. And we'll talk a bit about the risk profile things we touched on earlier. So with this next slide, I'll turn over to Andy.
Sounds good. So I'm one of the newbies up here. Jeff is probably newer to NorthWestern, but he definitely has more experience in the industry. But some of the numbers that we've seen in the slides kind of surprised me as we were putting this together. I sit on the board of a tax increment finance district outside of Butte, kind of our industrial park out there. So economic development and retention has an important place. Some of the things that I might do outside of NorthWestern. So thinking about the different ways that some of our metrics can increase what might be cost of debt that ultimately customers will get exposed to really makes it apparent that, a company like NorthWestern can't sustain the amount of capital investment that it makes in the state, as we see here for the 2022 to 2026 capital forecast, over $2 billion over the next 5 years forecasted to be invested. And then one of the numbers on the last slide was over $2 billion of annual economic impact on the state's economy. So those numbers are huge. So it's important that we recognize that we need a financially strong utility in order to facilitate that and sustain that economic impact. But so the next slide kind of deals with regulatory mechanisms, some of the different things that could be available out there that could help a utility either have a more predictable opportunity to earn those rate of returns and recover some of those different expenses and dealing with regulatory lag as well. And actually maybe following up on Commissioner Pinocchi's question about how a utility can improve credit metrics without necessarily increasing customer rates. I think different regulatory mechanisms might be a way to achieve that. Thinking about other regulatory mechanisms ultimately give a little bit more predictability to the utility that whether or not it would earn its costs or recover its costs that it invests either in the system or operations and maintenance costs. So if we look at the graphic on the right, this came from an S&P Global report, and it shows across the country different jurisdictions and basically has different colors there for the number of different regulatory mechanisms that are offered by commissions in those various states. As we see, Montana's on the lower end of that. Part of that could just be because there's only not as many regulated utilities in the state. But there are also other different regulatory mechanisms that could be available. So some of the different things that are there, one obvious thing that NorthWestern and NorthWestern's customers in the state of Montana has definitely benefited from over the last 13, 14 years is the pre-approval statute. Ultimately gave a little bit more of a reassurance to a utility that it would recover those costs for investing in those new generation or purchasing generation. So that's something that helps to build that predictability to give those creditors or equity holders more assurance to make those investments or to make those loans. Some of the other things, Fuel, purchase power, gas commodity is the first line there. We have a gas tracker that works pretty well. You know, the cost of gas that NorthWestern has to procure for customers. Ultimately, NorthWestern pays for. That's again a pass through. You know, there's not anything that NorthWestern makes money on the actual cost of gas procured, and customers' gas supply rates are adjusted monthly for that. We've also got the power cost and credits adjustment mechanism, works in a similar way, a little bit different timing, and also kind of requires NorthWestern to either share with customers and kind of that 90-10 ratio. And so there are different mechanisms out there that we can think about, different ways that NorthWestern can ultimately get a little bit more assurance that it would recover those costs. We did have a docket recently, our Pcam base update that I think you're all aware of, that we talked about. Ultimately, that docket was dismissed, and ultimately NorthWestern wanted to increase our base power cost and credits to kind of set what that baseline would be to determine where that sharing percentage would start. And we kind of heard that message loud and clear from the commission that it sounds like, you know, we can only update that base in a generally contested general rate case. So when we announce that we'll file an electric rate case next year, we'll probably be talking about something to do with our power cost and credits adjustment mechanism and kind of following up on that docket. So those are things that regulatory mechanisms that address some of those costs that either may or may not be in under NorthWestern's control. For example, you know, we talked about the different energy prices that NorthWestern is exposed to, or I should say NorthWestern's customers are exposed to when it comes to NorthWestern not having enough generating capacity to meet those peak needs, either in the winter or the summer when weather is volatile. So NorthWestern has to go out to the market, procure that energy, and sometimes that's at very high prices. And a lot of that is outside of NorthWestern's control. So there are other regulatory mechanisms as well that we could think of as being mechanisms, but one of the current Pcam docket that we have out there as well right now, we have a proposal to basically increase the amount of hedging that we can do, sort of as a way to try to alleviate that risk of being exposed to those high prices that we might see when those markets really spike during high demand, either that we experience in the region or nationally like we did last February. So different mechanisms out there that can really help with those items. Another one there is decoupling. In our last general electric rate case, we did have a decoupling proposal that went into kind of that pilot program that I think you're aware of. We probably talked a lot about this past summer. Ultimately, the way that works, NorthWestern sets its fixed cost revenue requirement, and the decoupling mechanism allows NorthWestern the ability to earn that fixed cost, that revenue requirement, and adjust customers' rates so that NorthWestern essentially isn't exposed to all that different volatility and load, whether it's a high load year or low load year. We earn that revenue requirement. Only residential and small general service customers were part of that pilot program. And then all of a sudden COVID happened and we saw those load profiles totally change. So we learned an important lesson, but FCRM, our fixed cost recovery mechanism, is another important regulatory mechanism that could alleviate some of that risk, helps credit metrics as well. So those are some of the things. There's other things like infrastructure riders that are available to other utilities, other jurisdictions that might give them the ability to recover investments a little sooner so they're not exposed to sort of the long regulatory lag that we might see. And I think we have a slide here, a couple pages down that we can look at as well. So definitely just some different regulatory mechanisms that can reduce that risk. And Crystal, I don't know if you have anything else you want to follow up there.
Yeah, I mean, the only thing I would add to that is, the kind of center call out box hits this, but regulatory mechanisms, typically it isn't that the cost wouldn't be recovered. It's the timeliness with which, right? And, how much you put everything in the kitchen sink in rate cases and how much you as a commission want to take up the other things outside of rate cases. You'll see that the amount of mechanisms, pre-approval is something that's been used in Montana. Many other states approve IRPs and then just have a rider for that same answer, right? Which is reducing regulatory lag and providing that the commission has the policy overview on supply type investment. So there's a lot of different mechanisms around the states. This gives you a picture that, again, you're all engaged at the national level with other utilities. So you have some perspective on that. I know at times, we've had conversations with the Consumer Council. They'd be happy to have no mechanisms whatsoever. And my answer to that would be just this middle box, which is we'd be in every year for a rate case because there would be no other option there. So it's what most commissions find is a balance between what are the issues that should be taken up in a broad rate case and what are the issues that a mechanism leads itself to. So with that, I'll get to the Pcam and Commissioner Pinocchi's question earlier, which is, market prices broadly are much higher for electricity. Our price doesn't change to customers except for the pass-through side. So when we went from a pass-through tracker to this Pcam design, which several of our peers have, such as Avista and Portland General, this really is how those both our Moody's and other credit ratings and equity investors look at us and think about us, which is we have a mechanism that has risk to it from a shareholder perspective. And we have more risk because we're more on the market. So if you look at the bottom, that's our portfolio and how much we have in PPAs and are on the market. So how much exposure we have then above that when we hit peak. If you look at Avista, Portland, Idaho, because they're roughly 100% of resource adequate, the amount of risk inherently in whatever mechanism they have is greatly reduced. And then, the design of the mechanism is significant there. So you think about that. We're in the market when we need power the most and we need capacity 24/7. You can absolutely get it. That's expensive. And then at other times we're selling into the market when we're excess long energy. And the amount of QF power that's come on our system, the variable power, that sort of thing. So we're balancing that world and in the market when it's most expensive. So when the credit ratings agencies look at us and look at the impacts to us, they consider us more risky. That's the net of how they think about that mechanism and how it applies to us. And really the best way to see that is our peers, if you look on the left-hand side, own far more generation, control the cost to customer in that regard. We're much lighter on that. So they inherently view us as more risky. Commissioner Pinocchi.
I agree with you completely. So why didn't we put a turbine in Hebken? Why aren't we making a deal with Gibson?
My comment to that would be we file our resource plan every 2 years and we'll be in front of you as to where we think the next steps are to fill out that portfolio, what we should own, and that's the right time to engage in that conversation.
Also, another point of view is in Great Falls, we have a turbine that was recently torn apart and put back together. And now it produces more energy than it ever has before. Somebody explained to me that the insulation around the wiring was far thicker 100 years ago than it is today. And with more copper and less insulation, it generates more electricity. So if we were to upgrade every turbine to be more efficient, this should help raise your credit rating.
Yeah. And the thing I will tell you is we're filing a rate case next year and you'll see quite a few hydro upgrades that we've done on our system as we can fund that capital and get the work done to make those units more efficient. And they are producing more today than when we bought them and brought them onto the system in 2014.
Thank you.
So last page, I'll flip it back to Andy and then I will wrap up from there.
Yep. So, and just follow Crystal's comment about regulatory lag. Typically NorthWestern continues to invest in the system to maintain its infrastructure. And ultimately what that means is our rate base continues to generally increase pretty much every year, but we don't earn on that new rate base until we file another general rate case, essentially to present all those costs, all those capital costs, all those expenses to you ultimately to approve new rates at that point in time. So there's regulatory lag that happens, and we could essentially, like Crystal mentioned, we could go in theoretically every single year, file a new general rate case. I don't think you want to sit through that, and I don't think we probably want to make those filings, as we know that there's a lot of work that goes into general rate cases, a lot of cost. A lot of cost on the commission's side as well as the staff are bogged down with a lot of those dockets, and a lot of costs for all the other organizations that are parties to that case too, and hiring expert witnesses and things like that. So it's not necessarily feasible to file continually like that. And when we look at this slide, we just looked at the timeline of our very last electric rate filing that we did make. The test year for when we kind of consider what those costs are that we will recover occurred from December of 16 through December of 2017. Our rate base is determined based on a 13-month average. So those are the costs ultimately that we put into the rate base. And then we made that filing later in September of 2018. And then months later, April 1st, the commission met, essentially discussed the interim filing that we made along with our filing and discussed what might be appropriate to approve for interim rates at that point in time. So it really did take 14 months at that point in time to think about before, we incurred those costs, or if we even think about the way the 13-month average works, it's probably more like 18 months before we actually begin to collect some of that cash flow. So in thinking about ways that we might be able to reduce that regulatory lag, in this next rate case that we do file, we'll probably be trying to make a proposal that might give a little bit more information into our interim request, that we would be hopeful that maybe there'd be a little bit sooner of an approval, that we could, begin to recover some of those costs a little bit earlier rather than later, just something that helps to reduce that regulatory lag. And then some of the other items, the dots on this slide, we filed the settlement shortly after those interim rates went into effect with some of the other intervening parties. And then, it took a little bit of time for the commission to ultimately review the settlement, think about what those rate impacts were. And then in October of 2019, the settlement was actually approved. And then takes a little bit of time to work with commission staff as well, and thinking about what those rates ultimately will look like. We present our compliance filing, and the commission staff does a really good job of reviewing all that, sending us any questions if they do have. So it wasn't until March of 2020 that the final rates actually did go into effect. So it just gives you a little bit of color on kind of what that regulatory lag timing is.
Okay. So 2 hours we've been at this and we really appreciate the conversation and the good back and forth and great questions. So with that, I will wrap it up with any questions and try to be respectful of time here.
Thank you. Let me follow up on my earlier statement of my conundrum, and that is that this discussion and the previous ones that I mentioned help me to understand more of when we're supposed to hit a fair balance, what being fair to the company means. Okay, I get fair to the ratepayer. That's clear enough. So, this has been helpful in that regard. The second thing is that when you're talking about the mechanisms you talked about, I remember when I first got here nearly 5 years ago, and Mr. Rowe invited me over to meet a bunch of people in the office of Crystal. You might have been one of those people. The room was filled with all sorts of people. And I said something then that I still believe in now, but I don't know how it's possible now. And that is this: I believe in incentives. Okay. And I said that, I'm a NorthWestern electric ratepayer. Let's say, for round figures, there's 400,000 customers. It says if you can save me and every ratepayer $10 a year, that means you save ratepayers $4 million. And if you as a company can make an extra $1 million by saving us $4 million, go for it. That's what I mean by incentives. And so any suggestions that you have on how we can incentivize, I'm all for that. Also, Andy, your comment about not wanting to have frequent rate cases, it's such a joy seeing this room filled with 25 different attorneys. It's just, nothing matches it at all. And the last thing I would say is that you have picked the right person to be your controller, because he has controlled himself throughout this entire meeting, not uttering a single word this whole time. So thank you for your presentation.
Commissioner O'Donnell, I told him all the hard questions were actually going to come to him. But the other thing I would just comment on your performance-based piece, and I don't know, devil's always in the detail, but Florida regulation, FPL has like an earnings band, performance-based incentive. There's relative moving along the regulatory policy side, and where Montana has been, which has a unique history, and where that might be, but that comes to mind as a place to maybe look that has a bit of an incentive structure. And I do recall you making those comments and the one that comes to mind is Florida, and they have a bit of a design around an earnings incentive.
Additional questions from the commission? If not, I would very much commend you for staying within time. That's very much appreciated. 1 minute over, I would say you're still well within time given the questions. So thank you for doing that. Second, thank you for your presentation. It was very informative. Appreciate having this conversation. I'm sure my fellow colleagues would express that sentiment. And then before we adjourn, let me wish you a Merry Christmas and a Happy New Year.
Christmas. Absolutely. Same to
All
you.
right. Be safe, travel safe.